Hey folks, signal and noise ending December 5. Santa is closing in. We're going to need a Santa rally after the last month or so. The ASX lost a bit of the gains year to date. So year to date, the returns are not actually that good. But anyway, that's the way it works out. Well 2 and well 3 are still doing well, as is well 1. So anyway, generally we might have a bit of a Santa rally. It looks like the market's turning around a little bit, so we'll wait and see. The one thing I'm concerned about is, as you know, 2026, where I think we could have the start of either a very short-term vicious decline or a longer-term slow one. Either way, it doesn't really matter. If you lose 50%, it doesn't matter if you lose it in 12 months or 5 years, you're still down 50%. My concern is that, well, it's not really a concern, just pointing out that we may get a melt up as the bubble continues. And so it again, you may look at that and say, oh, this is terrible. We're all wrong. It's going to go to, it's going to go to the heavens. And then at some point it turns around and starts the decline. As we've been saying, we don't know when that is, but we're just looking at it in terms of valuation and getting to understand that it's getting a little bit crazy out there. Okay, so macro moments. Venezuela's heating up with the Americans putting pressure on the president of Venezuela, Maduro, to skedaddle out of the joint. That's going to be something that plays out for a little while. Russia is also threatening Europe. And China is pressing on Taiwan. What you've got in the broader picture is the three main players, America, China, and Russia, are generally trying to secure their own borders. The American national security strategy came out overnight. I'll dissect that for you at some stage later this month. Reason why is because it's imposing its changes on the world economy, which will flow through to companies and country investments. So, but what you're seeing is China is trying to get Taiwan to help its trade routes. America is doing the same with Venezuela, and Russia is doing the same with Ukraine. We can expect this to go on for a fair while. These are not things that are solved overnight. One of the big issues really coming out of it, though, is the extent to military buildup. The Americans, we can expect them to continue on. Same with China, same with Russia. The big question mark really is Europe. Europe is probably trying to have it both ways. Europeans are having a decent whinge about they don't want to be bossed around by the Americans, but then they want the Americans to protect them. So Europe's got a rude awakening coming. It's either going to have to go it alone, which will necessitate that it's going to have to turn more inward and think about more internal matters, which will be how do we get cohesion across 25 separate nations with sort of some of them with diverging interests. So that'll be fun to watch. Anyway, that's what's sort of going on around the world. More locally, we've got figures out during the week that growth is roughly about 2%. On a per capita basis, that's not very good. Inflation's running at about 3.8, which makes it even worse. So we're not exactly knocking the lights out here. Some wages came in that looked a little bit better. And as the same with America, we're spending a lot of money building AI data centers. And I don't know how that's going to end up, to be quite honest. But anyway, the big concern for me is the housing credit. It's exploded in investor terms. That's what I think is a major concern. Again, Jacob, Tom, and I will talk about that on the podcast over the coming few weeks. The reason why is because the size of the debt in the housing market is very high, and that will probably dictate what people will spend their money on over the next 5 to 10 years. So I'm just going to give you a very rough example. Okay, so we all have a mortgage and we all have an investment property, and it's actually not performing that well in terms of capital gains. We're negatively geared, and it's costing us a couple of $100 a week. But we don't want to sell it because if we sell it, we won't make money. So we're going to sit on it and hope that it turns around. In the meantime, I'm not going to buy the latest iPhone or spend electronics at JB Hi-Fi or Harvey Norman or Amazon. When I go to Woolworths, I'm going to buy just a little bit lower brand of chocolates. I'm not going to buy Doritos corn chips. I'm going to buy the Woolies home brand corn chips. They're the sort of things that sneak in to people's expenditure when things start going, when the going starts to get tougher for them on an individual basis. Because we've got a lot of debt spread across a wide strata of Australian society, I think that's going to be one indicator for me that shows that we might be heading into a little bit of trouble. And I've mentioned this before, you see a lot of people talking about restaurants, like, oh, I went out and restaurants were full. I did it myself last week. I went to Chermside Shopping Centre and drove around for 20 minutes because I couldn't get a car park. So I eventually left. But the point being, that can be deceiving because what you're seeing is, I think you're seeing a bit of pre-Christmas spending. But the other thing is too, that doesn't necessarily mean that things are going well. All it means is people might be at Chermside buying, and instead of, as I said before, instead of buying something that's worth $300, they buy something that's worth 150. So again, they're moving what Japan did in the 90s, which was people stopped consuming the sort of good stuff and moved towards debt consolidation. When you do that at a consumer level, that means someone else has got to pick up the extent of so if I stop spending, you got to start spending some more to make up for it. The only one really left that can do that is government. And Albanese and Chalmers, in their wisdom, are now looking for government savings, which is beyond me. But anyway, that's the way. So anyway, look, I think it just seems like the property market's reaching its peak or getting close to it. And I think we need to have a think about that going forward in terms of stocks. Lesson of the week. What I'm doing there is again reiterating this point. The reason why this point is really important is because over the next decade, I think the opportunities are going to be less available than they have been in the past 15 years. And what I mean by that is in the last 15 years, you could have bought anything, gold, stocks, bonds, real estate, doesn't matter, a crypto, you've made money. I think that's going to be different in the next decade. And so what I'm sort of emphasizing here is saying when you get something with a cheap cape ratio, um, what you should do is really have a look at that in a longer term context. Because if the geometric return at the start is going to compound at 9 or 8 or 9%, that's actually going to be really good for the next decade because the US stock market ain't going to compound at that rate. I can tell you, not from a cape that's currently at 40. So that's something for everyone to have a think about.